Success in Forex relies on measuring the intensity of price movement to identify when a market is poised to release its energy. Bollinger Bands provide the technical framework for this measurement. Developed by John Bollinger in the 1980s, these bands allow traders to map out market cycles and recognize potential reversal points. By the end of this tutorial, we will configure the tool, apply a momentum filter to reduce false signals, and walk through 2 actionable trade setups. To begin, open your charting software, select a currency pair, and ensure you are working within a demo account. Layering these indicators onto a standard price chart provides a visual structure for navigating shifting market cycles. Open the Indicators tab and apply Bollinger Bands using the standard settings of a 20-period lookback and 2 standard deviations. The center line is a simple moving average, representing the mean price over 20 periods. The upper and lower bands are plotted away from this baseline, acting as dynamic boundaries. Measuring standard deviation, these bands react in real time, widening during volatility and contracting during quieter periods. This dynamic movement provides a mathematical gauge to determine if a currency is statistically overextended or trading at a relative discount. The first setup to look for is the Bollinger Squeeze. This occurs when the upper and lower bands pinch tightly together, reflecting a period of low volatility. Markets rarely remain in a low volatility state for long. A tight squeeze often precedes a significant breakout, building necessary momentum for a new trend. It is impossible to know the direction of the breakout while the price is still confined between the bands. Guessing the direction at this stage often leads to premature entries. Confirmation requires a price candle to close outside the bands. A candle closing above the upper band or below the lower band signals the direction of the new trend. Using the squeeze allows a trader to react to confirmed momentum rather than attempting to predict a move before it happens. In a sideways or ranging market, prices often oscillate between the outer bands. This is the Bollinger Bounce, where the bands act as points of support and resistance. To trade a bounce, wait for the price to touch the lower band and form a rejection pin bar. This suggests support at the boundary. The initial profit target is the middle SMA, with a secondary target at the opposite band. The bounce strategy is designed for ranging markets and will often fail if the market enters a strong trend. In a powerful uptrend, the price will often hug the upper band in a move called walking the bands. This price action indicates trend strength, not a signal to sell. During these trends, the middle SMA often provides support. Traders can use touches of this center line to add to their positions in the direction of the trend. Distinguishing between a bounce and a walk prevents the fatal error of trading directly against a high momentum move. Relying solely on a band touch during high-impact news events can lead to false signals, as momentum can push price through the bands temporarily. Adding the Relative Strength Index, or RSI, provides a secondary check on price momentum to confirm these signals. Look for a setup where the price hits the upper band while the RSI shows a bearish divergence, making lower highs while the price makes higher highs. This suggests the upward momentum is fading. Combining a volatility indicator with a momentum filter increases the probability that a reversal signal is valid. The configured chart provides a visual framework for identifying volatility, momentum, and price overextension. Technical tools require practice. Avoid risking capital until you have verified the reliability of these setups within your own trading routine. Use a demo account to identify 1 Bollinger Squeeze and 1 filtered bounce setup. Execute these as paper trades to observe how the bands react to live price action. Use the bands as a map, but let price action be the final guide. Indicators reflect past data. Price movement dictates the current reality. Consistent practice with this blueprint is the most effective way to navigate Forex